London and Johannesburg listed Tharisa, a PGM and chrome concentrates mining specialist, has produced full-year results that show 119.8% rise in EBITDA on an 18.4% rise in revenues. All this from its Tharisa mine in South Africa on the platinum and chrome-rich western end of the Bushveld complex. The chief executive is Phoevos Pourolis, and he joins us now on the line from Johannesburg. Great day for you. Congratulations on the numbers. We know that the market you're selling into is buoyant at the moment. What's been the generator behind the big rise in these full-year numbers?
Yeah, so again, thank you for the time and to the viewers. So I think we're extremely proud of the fact that even through the COVID pandemic and the various levels of lockdown in South Africa, we've been able to continue to produce from our large-scale, low-cost open pit mine in the southwestern limb of the Bushveld complex, home to 80% of the world's platinum and rhodium resources and 70% of the world's chrome resources, of which we mine all of the above. And really, what's given us great comfort is the fact that over the last 2 years, we've been investing in the sustainability of our business. We've invested heavily in our mining fleet, in reconfiguring our very large open pit mine to be able to yield the volumes and increased throughput through our processing plants. So on the one hand, it's very strong performance in spite of curtailments due to COVID-19, being able to deliver the 142,000 ounces of platinum group metals and 1.35 million tons of chrome concentrate, which both have generated healthy margins. But importantly, as you mentioned, the buoyant platinum group metal basket price, on average for the year at some $1,700 per ounce. Now, bearing in mind that prill split is comprised of platinum, palladium, rhodium, ruthenium, iridium, and gold. And so that basket price at year-end was $1,700 per ounce, really driven by an average price of around $8,300 for rhodium and around $2,400 for palladium, with platinum being sub $1,000 for most of the year.
Stripping out well, if I could just quickly pick up on that, stripping out the rise in the metals in which you're selling into this buoyant market, are you happy about the way this year has started? Is your trajectory of the actual operational part of the business continuing? Because clearly you found efficiencies over this last year that's generated these sort of returns.
Yeah, absolutely. And I think if we look at the fourth quarter of the last financial year, that really guides us to our guidance for the next financial year, where we produced 40,000 ounces of PGMs and around 370,000 tons. So on an annualized basis, that's straight in line with our guidance of 160,000 ounces of PGMs and 1.5 million tons of chrome concentrate. So comfortable with the trajectory, comfortable with that sustainability of operations, and importantly, an even higher PGM basket price. So I mentioned $1,700 for the prior year, current spot basket price, $2,500, with rhodium unbelievably doubling to $16,000 per ounce on the back of a widening deficit of the metal going into the new calendar year. So really exciting times for us.
What about the capital expenditure? I noticed this is around $70 million in the last year. I think your projections are around about the 50 million mark. What is it that's going on here? Is this something you're aiming to do, is to continue to drive down the capital expenditure?
So it's a mixed bag, really. So sustaining capex is in the order of $50 million, but we do have a very special fine recovery chrome project, which we call the Vulcan, which is in construction at the moment, and that has a capex number of $46 million. So that's over and above the, let's call it the stay-in-business capex of $50 million. So by right, we should be averaging between $50 and $60 million going forward. It is a large operation. We mine millions of tons of waste and millions of tons of reef. To be exact, we'll be mining 5.6 million tons of reef and close to 20 million cubes of waste. So a large-scale operation. So the maintenance and the replacement of that yellow fleet is critical for the sustainability of our business in the normal course. So those capex numbers we see as healthy and necessary going forward. but will be supplemented with these special expansion projects, which are really in-house technologies that we've developed to extract more value from every reef of cube that we mine. And in particular, that Vulcan project will see our chrome output increase by 25%, getting to that 2 million ton per year target number that we've put out, and reducing our unit costs significantly because of the low operating costs of that plant.
I see you've got cash just shy of, I think, about $50 million. Your debt is $70.4 million. Do you see much of that changing over the next year? I mean, you're obviously a cash generator. You're a profitable company. You're operating in, as I said, a very good market at the moment. How do you see that debt level going? Is it your intention to try and drive that down? Or are you happy with this at current levels?
So as it stands now, I think most mining companies would be happy with the current levels that we're operating, net debt at 6.6% to equity. And with the cash that we'll be generating, we should see those numbers declining due to those additional margins that we'll see. So we've always given guidance that we'd be happy on a sustainable basis with around a 15% level of debt within the group. But we need to obviously make hay while the sun shines, and if we can get to a cash positive position, certainly we will. Bearing in mind that we do have the expansion projects in the Vulcan and potential other opportunities, which may see some lumpiness in the capex profile, but generally speaking, we see it well in hand and manageable at these levels and reducing going forward.
Well, you say about talking about the sun shining, I guess partly you're looking at a very bright market outlook in terms of your potential customer base, because I think you're selling into the electric vehicle market and the sort of the hybrid and the sort of environmentally friendly vehicle market, aren't you? Because a lot of your product goes into catalytic converters, which keeps us on the good side in terms of the environment. How big a market is this for you as a company?
Well, it's critical to all platinum group miners. So if we look at the hydrogen economy, which has been spoken about a lot more recently due to the drive to decarbonize the planet, hydrogen plays a critical role in the production of hydrogen, in catalyzing water into hydrogen and oxygen, and then converting that hydrogen into electricity for use in electric vehicles, not only passenger but industrial and light industrial vehicles, as well as providing a great zero emission solution for grid power generation. So we see a very bright future for the hydrogen economy, which really drives growth and demand in platinum itself. But importantly, and I think it often gets missed, the palladium, rhodium, and platinum that we currently mine is used in carbon emissions and noxious gases emissions curtailment. And we've seen with the increase in emission standards globally, including China, India, North America has been driving it, primarily California and Europe, we're seeing the requirements for emission standards increasing, and hence the loading or the percentage of these metals increasing in the autocats that are utilized to clean the air that we breathe on a daily basis. So the outlook on both fronts, on a renewable energy basis being the hydrogen economy, as well as the internal combustion engine or hybrid vehicle, looks very bright in the medium to long term for these very, very precious metals that we mine. So by all accounts, I think everyone is in agreement with the future demand for these commodities being very strong.
I think in the context of all this, with this a dividend announcement as well today, that clearly has pleased investors. Let's take a look at the share price first of all before we talk about the dividend, because I want to talk about this recovery that we've seen here. The highs that we had, this is the London listed shares, the highs we had back, what was that, this time last year, we were around about at £1.21, currently trading 88 and 3/4 pence. We're up today in today's session as a result of these numbers out this morning, which beat expectations. But you've announced this dividend about 357%. What's the cover here and the yield that you're providing investors with a dividend at this sort of level now?
So our dividend policy is to pay out a minimum of 15% of net profit after tax in the form of a dividend. And this year we increased that to around 17%. So it's not a progressive dividend, it's based on the profitability of the business. And the basis and the theory behind it is that if there's cash generated, we, over the last 5 years, have demonstrated that we will distribute and share those benefits with shareholders. So I believe we've rewarded shareholders on an annual basis, but it is subject to the profitability of the business. So one, it's difficult to forecast yields going forward. In terms of the policy, as I say, a very healthy increase in the quantum, or as you say, of just shy of 400% year on year, just short of $9.5 million being paid back to shareholders on the 16.2 cents earnings per share that we declared during this financial year. So the question we have from analysts is, are we going to have a progressive dividend increase year on year? And I think by the nature of the business being a volatile industry, commodity prices, exchange rates, it becomes quite challenging to commit to that. So I think we're comfortable with our policy and happy to upsize it at the appropriate time. And this is the recommendation of the board to shareholders to approve at our AGM.
One final thing. I think this is really a global issue now. Of course, we're talking about COVID here. I noticed on your website you carry an updated report from the Ministry of Health in South Africa. Very interesting to listen to that and to see just how it compares and contrasts to what we're hearing here in the UK and what we're hearing in other countries. Clearly, South Africa is very concerned about this, and it has in place a track and trace system and so forth. I know that presumably companies like you benefit from. I notice actually you haven't really suffered that much as a result of COVID. How have you swerved it to the degree that you have?
So I think, first of all, the mining industry, in particular ourselves, we've been very well equipped to deal with healthcare issues. You are well aware of the HIV issues and tuberculosis issues that we have in our society. So our systems that we had in place for monitoring, tracking, healthcare clinics, so forth, we're all entrenched in our culture and our operating practices. So when COVID-19 came in, we took guidance from the Ministry of Health, the Departments of Minerals and Resources, and we implemented the protocols and in some cases went beyond that. So it was really bolstering on an existing system of healthcare that is entrenched in mining in South Africa. So it was relatively easy for us to equip ourselves to, one, monitor, track, do vigorous screening of our employees. And by the virtue of the fact that we're a large-scale open-pit mine, we could affect social distancing very easily. Simplistically put, you've got one driver in a dump truck and one driver in an excavator. They're not in the same area, they're not in the same cabin. So social distancing for us was never really an issue. Even though we have a large labor force, it's a big operation, and the roles and jobs are isolated by nature of the mine we have. So for us, we recorded 56 positive cases on site with staff complement of direct and indirect employees, including contractors, of around 3,000 employees. So very low prevalence rate. And unfortunately, one of our colleagues succumbed to the symptoms of COVID-19 and passed away. He was not at work, he was off-site. And that brings home the reality of the pandemic that we're dealing with. But in effect, we were not impacted from an operational point of view, other than the fact that we followed the various lockdown levels that the government implemented from level 5 right down to level 1 where we stand now, which did have a curtailment of operations where we could operate at certain percentages.
Just one final question. I guess this in part goes back to the share price as to where we are in the context of where we were pre-COVID. What is being priced in now? Because you seem to have produced numbers which, as I say, are greater than expected. And I think given the current share price and where it has been, are you disappointed that the shares are as low as they are? I mean, what does it represent at 88 pence a share?
Well, at current price levels, we're trading at 0.5 NAV on an EV over EBITDA 1.6, I think the lowest in the sector. So what it does is it presents an opportunity for some real upside potential for new investors and for those existing loyal shareholders, potentially a re-rating in their stock valuation. I think it's still early days. I think we've just released these results, and hopefully the market digests them appropriately and gives us the due recognition for the sustainable improvement in our operations. And the key here is that it's repeatable and sustainable. It's not a one-off. And in an unimpeded 2021 financial year, we should see our results improve even further.
Well, we look forward to seeing more about that. And thanks indeed for joining us. And good luck for this current fiscal year. Stay safe. Phoevos, it's good to talk to you again. Phoevos Pourolis is Chief Executive of Tharisa.